This is Barry Knapp with Ironside's Macroeconomics. It's Monday morning, July 15th at 7 a.m. Mountain Time. This is the introductory version of the weekly audio summary that walks through our marquee product, which is our weekly note. The note this week was titled Healthy Broadening of Disinflation. We've been poking fun at that healthy broadening out that so many have talked about with respect to the stock market all year. We got a little bit of a taste of it last week, but again, explained why we think it's doesn't make a lot of sense to be buying small caps here. There was no great window of opportunity, but that was the genesis of that, the title of the note. We discussed price stability and the healthy broadening out of disinflation at length. That's the theme that runs through the note. And we talked about the implications for monetary policy and even financing the government. We have a section on a speech that was given by Josh Frost, which is the Assistant Treasury Secretary responsible for the quarterly refunding announcement we're going to get at the end of the month, and the question about whether the Treasury cuts their bill issuance. They're issuing greater than the 15 to 20% recommended by the Treasury Borrowing Advisory Committee. We suggest that they extend duration and issue longer term securities, but I'll come back to that issue in a minute. So first on price stability, while inflation has been dropping from 9 at its peak in mid-22 down to 3% by mid-23, went back up towards 4, but is back down to 3. Through that entire process, the standard deviation of CPI has been falling. We measure it using the annual standard deviation of annual all item CPI, and it's down to less than 20 basis points, where it was in December 19 before the pandemic hit. That's a rare level. It's actually rare that it persists below 50 basis points per annum. That happened in the beginning of the 60s, early part of the 60s, late part of the 90s. It was happening a little bit right before the pandemic. And that creates a really attractive investment environment. We would note that the VIX and MOVE index have been falling steadily since October, even through the rebound that we had in first quarter inflation. So that inflation volatility coming down is really good for the investment environment, particularly for equities and capital formation. So that's a key theme there. But there was a cost associated with it, and growth is clearly slowing. We've seen that in the GDP tracking estimate that we were cynical of when it was first released at the beginning of May or so. We first started getting the first data for the second quarter of GDP, the second quarter of the year. That was GDP tracking estimate was 4, now it's down to 5. Growth is clearly slowing, but unlike the second half of last year, where the disinflation was almost exclusively reliant on falling goods prices, it has broadened out to super core and to even we got a decent housing inflation print last month. So it is time for the Fed to start cutting rates. We think they should be going in July. We'll hear Powell speak at noon today. We doubt they will go in July. More likely they'll wait for GDP, the employment cost index, the first estimate of the benchmark revision of the establishment survey, and he'll give a speech at Jackson Hole that tells us he's going in September. In the meantime, growth could deteriorate enough that they could get forced to actually go 50 in September. So they've waited too long. They should have never done the last 3 hikes. The Phillips curve and Beveridge curve are both indicating that the labor market's in a precarious spot. Any further weakening of demand and the unemployment rate could start going up non-linearly, which is a statistical way of saying really fast. So we definitely think they should be going. We then went on to discuss the quarterly refunding announcement and to make the recommendation that they should be issuing more longer term securities. We had a section on financialization. For those of you that either caught us on Charles Payne's town hall last week that was rebroadcast yesterday morning, or you saw that on our Twitter feed or the Substack chat feed, by all means have a look. We explain it in the note in more details. And wrap up the note this week with our argument that there's no real great case for buying small caps. It would be something if they had fallen 10 or 15%, not underperformed by 10 or 15%, but actually gone down. And the Fed was on the verge of an aggressive rate hike cycle, because the key issue here, and you can see this in the chart that I have up if you're going to look at the YouTube video version of this, is that we still have a very deep yield curve inversion. And that time to disinversion to get the Fed's policy rate to 4% is crucial. And if it takes them all the way until mid-year next year, which is where the markets are currently priced, small cap earnings won't start to rebound for 6 months before that. So that time to disinversion is really critical. And so we would not buy small caps here. We would, however, add some duration and move out into the belly of the curve, because despite the Trump trade dynamics this morning, we do think there's room for the Treasury market to rally further. That's it for me this week. Barry Knapp from Ironsides. Have a good week, everyone. Thanks.